Global stock markets experienced a significant downturn on Friday, August 1st, 2025, largely driven by a combination of new U.S. tariffs and disappointing economic data, particularly the weak U.S. jobs report. This marked a sharp reversal from earlier in the week and late July, which had seen some major indices reaching or nearing all-time highs. Friday, August 1st, 2025, performance. The day's trading was characterized by broad-based selling across major markets. In the United States, S&P 500 fell 1.6%, its largest daily percentage decline since May, closing at 6,238.01. This also snapped its recent winning streak, ending the week down 2.4%. Dow Jones Industrial Average dropped 1.2%, 542.40 points, to 43,588.58. NASDAQ Composite slid 2.2%, 472.32 points, to 20,650.13. Russell 2000, Small Cap Index, declined 2% to 2,166.78. Internationally, the sentiment was equally negative. Germany's DAX fell 2.7%. France's CAC 40 declined 2.9%. South Korea's KOSPI tumbled 3.9%, also impacted by new corporate and capital gains tax proposals. Australia's ASX 200 fell 0.92% to 8,662 points. Key drivers of the downturn. U.S. tariffs. President Trump signed an executive order imposing reciprocal tariffs ranging from 10% to 41% on imports from various trading partners, including India, 25%, Taiwan, 20%, Switzerland, 39%, and South Africa, 30%. Tariffs on Canadian goods were also raised from 25% to 35%. This new barrage of protectionist measures significantly dampened global trade sentiment and raised concerns about potential retaliatory actions. Companies like Apple, for instance, are forecasting substantial hits to their revenue due to these new fees. Weak U.S. jobs report. The July non-farm payrolls report was surprisingly weak, with employers adding only 73,000 jobs, significantly below the 95,000 economists expected. Furthermore, there were substantial downward revisions of 258,000 jobs for May and June payrolls. The unemployment rate ticked up to 4.2% from 4.1%. This data fueled worries about a weakening economy and raised expectations for potential Federal Reserve interest rate cuts. The yield on the 10-year Treasury note notably fell to its lowest level since early June in response. Geopolitical tensions. Reports of President Trump ordering nuclear submarines to be positioned in appropriate regions in response to warnings from Russian officials also contributed to heightened risk aversion in the market. Broader trends and outlook. Despite the sharp decline on August 1st, July had been a strong month for U.S. equities, with the S&P 500 notably showing resilience and repeatedly crossing into record territory. This was attributed to a mix of positive fundamental and technical factors, including strong earnings reports from several companies. Meta Platforms and Microsoft delivered particularly strong results earlier in the week, expanding market breadth beyond just tech giants, and improved macro sentiment driven by a thaw in U.S.-EU trade tensions earlier in the week. However, the events of August 1st ushered in a more turbulent phase, as market sentiment shifted. August is historically a flatter month for the S&P 500, with average gains of just 0.2%, making it the third weakest month. The combination of renewed tariff concerns, weaker economic data, and geopolitical jitters suggests that investors are bracing for increased volatility. Looking ahead, market participants will be closely watching for further developments on trade policy, upcoming economic indicators, and any shifts in central bank policy. The increased expectations for Fed rate cuts in 2025, now 2.26 expected 25 basis point cuts, up from 1.36, indicate that markets are increasingly pricing in monetary easing to counteract potential economic headwinds. While corporate earnings generally remain strong, the external pressures from trade and macroeconomic concerns are likely to dictate market performance in the near term. Tariffs and their impact on inflation. Tariffs are essentially taxes on imported goods. When a government imposes tariffs, it makes foreign products more expensive in the domestic market. Since businesses often pass a portion of these increased costs onto consumers, the final prices of made in the USA products also rise. This effect can be more significant for investment goods, as their import content is often higher than that of consumer goods. Finally, tariffs can reduce competition. By making foreign goods more expensive, domestic producers face less pressure to keep their prices low. This allows them to raise their prices and increase their profit margins, further contributing to inflation. Don't forget to subscribe, like, and comment.
So, no, I don't think so.